Welcome to NCC Group's full year results analyst meeting. I'm joined on the platform today by Atul, obviously who you're familiar with, Atul Patel, and Alex Stamos, who for him this is a big give up. Today in America on the 4th of July, we sort of abandoned them. It's very kind of him to be here on what is a big public holiday. Alex is going to talk you through the .secure and Artemis side of the business. Not in micro detail, there is an opportunity for that to meet him at other presentations. Please just be a little bit gentle with him. He's a little unused to the pressure that you're going to place him under, so difficult questions on numbers. Atul will jump in very quickly and help him out, so please be kind. Okay, so moving on. The agenda today is fairly standard. I'll talk you through the highlights. Atul will take you through the financials and the cash flow. I'll then take through the issues and opportunities in both the escrow and the assurance business before handing on to Alex, who'll talk about Artemis and .secure. And I'll then summarise the position of current trading. We'll do Q's and A's afterwards. If anybody does have a question, please wait for the microphone to be handed to you. And if you could, please say who you are and where you're from into the microphone clearly before the question. That will aid the video cast that's going out and it'll be your opportunity for everlasting fame. To the highlights, it certainly is fair to say this has been one of our more challenging years. I'm not going to step away from that. But within there are still some pretty big positives. The group revenue has grown. It has grown by 13% to nearly 100 million. We have seen growth in all the other business areas. I'll touch straight on escrow. Escrow only grew by 2%. The issues that we had in America and Europe are largely addressed. In terms of the assurance business, we've seen good organic growth. 10% organic growth is still a strong number. A 17% growth in operating profits. We are very positive about the marketplace that we're in. Yes, there have been issues in America, which I'll touch upon. We have had areas with the two acquisitions that have not come in as the way that we would normally expect. Of the two, Matisano, it's fair to say, has blown the doors off the numbers. It's having a fantastic time. It's exactly the business we expected to buy. And Intrepidus, I'll talk about a little bit later in more detail, has proved a little bit more difficult to integrate as fully and as quickly as we'd like. If we then look at Artemis and .secure, I think we can condense it down to progressing well. Yes, it is going very well. There are lots of challenges ahead in terms of delivering the service, and Alex will talk about that. Yes, through the ICANN process, we've been approved on the initial evaluation and so have Amazon. That is the big question. How will that contention play out? But I believe Alex will talk you through some of the ways that actually not even having .secure still will make the internet a safer place. The value in the proposition that we're creating is enormous. It has a fantastic future, .secure, and one that we're very committed to following through. And again, if we then look at the final dividend we're making, you'll see it has grown by 16%. I think that just reflects the confidence that the management team has for the year that we're moving into.
In terms of revenue, firstly, overall group revenue has grown very strongly at 13%, of which 8% is organic. Escrow UK has shown solid growth at 3%, and Escrow Europe has recovered from in the second half of the year and had a strong performance during that period. At the half year, if you recall, the revenue declined by 7%, so it's a good return to form. In terms of Escrow US, it's been a tale of two cities. Atlanta grew by 16% and San Francisco declined by 10%. Both Europe and San Francisco, the issues have been really around local management issues. We now have a stable management team in both areas, and we're confident that going into the new year, we should return to more sensible levels of growth. In terms of assurance, assurance has grown very well, 18% in total, 10% organic growth. This is on the back of following a very strong year last year as well. And during the year within assurance, we've also added two acquisitions, Matisano and Intrepidus, which will add the capability and also grow the division for the future years. If I talk about profitability, escrow margin has slightly ticked up from 58%. Assurance margin has remained at 17%. The overall group margin has reduced from 27% to 24%. Firstly, because of the mix of business between escrow and assurance, with a greater proportion of business now coming from assurance. Secondly, because our P&L charge for Artemis costs. And thirdly, because in the US we have invested in our corporate costs. We have invested in both the infrastructure and the support functions to get better control of the US. In terms of EPS, if I just move you down to the EPS number, that's increased by 8%, which you'll see is significantly more than the profits increase. And that's because our tax rate has reduced from 28% to 23%. Some of the factors that have contributed to that include the UK tax rate reducing, but also the US treatment of both Artemis costs and acquisition costs have worked favourably in terms of the effective tax rate. As Rob mentioned, in terms of the dividend, the board proposed a final dividend of 2.12p, which will bring the total dividend to 3.1p, which will be a growth of 16%. In terms of the items we have between reported profit and adjusted profit, the first one, exceptional costs, they primarily relate to acquisition costs for Matisano and Intrepidus, the deal costs associated with those acquisitions. The second point is our reassessment of the deferred consideration in the balance sheet. As Rob mentioned, Intrepidus hasn't really started as well as we had liked it to start. We've reassessed its likelihood of achieving its full earnout, which was 3.5 million. And we've taken the view that we think that it's more likely to be 2.5 million. So there's been £1 million, which has to now, with changes in international accounting rules, be shown on the P&L. So we've released £1 million. The balance relates to Axona. Their final earnout payment is due in October, and we don't believe they will achieve that. Amortization here relates to amortization of acquired intangibles. And the other thing I just wanted to point out on this slide was the impairment loss. That relates to, in terms of last year, to the abandonment of the SAP project, if you recall. Cash flow. The group continues to be a good generator of cash from its operations. Normal use of its cash is acquisitions, CapEx and dividends. The acquisitions cost of £10.5 million, that is the initial consideration for Intrepidus and Matisano, and the full final payments for Escrow Associates and ISEC, which happened earlier in the year. So looking at cash in more detail, our cash conversion has improved in the second half of the year to 116%. And based on our change in business mix, going forward, we anticipate our cash conversion to be more in the range of 100% to 110%. And that just reflects really the mix of a greater proportion of revenue coming from assurance. Net debt has improved to 25.3 million. And earlier in the year, in April, we announced that we had renewed our facility with the Royal Bank of Scotland. In terms of that process, we went through a full tender process. We believe we got very good rates. Previously, we paid 2% above LIBOR. The new arrangements we've got range from 1.5% up to 2.25% based on our net debt to EBITDA ratio, and we expect overall to be at the bottom end of that range, so paying closer to 1.5%, 1.6%. We also slightly increased the facility from 35 million to 40 million. That just means that we've got headroom for acquisitions and investments, including Artemis investments. Our CapEx in the year was 4.9 million. And talking about Artemis and DotSecure, out of that, 1.1 million related to DotSecure. At the interims, we mentioned that total CapEx we expect to be £5 million, and we're still in line to get to those levels. We expect during this new financial year for the CapEx to ramp up as we recruit software developers to build the platform. In terms of deferred consideration, we've got 6.9 million in the balance sheet. Matasano, as Rob mentioned, is doing very well. It will earn its fair share earn-out, which will be £2 million, and that will be the main payment in the next financial year. And we're confident that it will actually achieve its second if it carries on going at the rate it's doing. Intrepidus won't get the first earn-out payment. They've still got 2.5 million which they can earn, and subject to them improving their performance, that's still there for them to get. And finally, on to IT systems. I mentioned earlier about the SAP project and the abandonment in May 2012. The reversion process back onto our legacy systems has been painful, has been time-consuming, but we are now there, and the business is now operating on its legacy systems. We also mentioned that we were pursuing the implementer, and we've named the implementer as Cyber UK. We continue to believe that we have a sound case against the implementer, and we continue to pursue them. Overall progress, it has taken some time, has been slower than we would have liked, but we expect mediation before the end of this calendar year. And then coming on to where we're moving in terms of our systems. We've looked in the marketplace as to what systems are out there. We've also looked at what we've already got, and the decision we've taken is a very pragmatic but also a sensible decision. We've got a lot of benefit from the existing systems. There's a lot of strength in what we've got. We've also looked at recent developments in our core applications, and actually what's in the marketplace has moved a long way from where it was. So what we're going to do is upgrade our existing systems and integrate them. That's the strategy in terms of the new group-wide solution. We're in planning phase with suppliers at the moment. We expect to commence and implement the system during this financial year.
I'll take you through the two divisions. Escrow. Escrow is still the cornerstone of the group. No two ways about it. The cash it produces, the margins it produces. It is still an extremely good business. The issues that have faced us across the last 12 months are all small. They're all fixable and all have been fixed. The one thing we couldn't take control of was the state of the market, and I think if you've read the stuff we've put out over the last 12, 18 months, we've talked about the software and services market as being a pretty ugly space. It has been. That has affected the UK business. The levels of growth, around about 3%, are not where we'd expect it to be. What we are seeing now is a small uptick in that marketplace. I think it is fair to say that some of the gloom is lifting. It's not a material sea change, but there's enough bits that we're seeing now to feel that marketplace is a little bit more likely to spend. I've always said that selling escrow, the best time to sell it is when somebody's upgrading their system or buying a new one. We're starting to see that taking place again. The UK, of course, is the mothership of the other business areas. Its senior management team is responsible for both the European and the American businesses. In Europe, we've talked about the issues that we had, particularly in the Netherlands, the general manager leaving a period of time ago, some significant staffing issues. When we closed the first half of this year, you actually saw our results were about -7%. We were 7% behind where we'd been the year before. We've actually turned that around now. The performance in H2 has been a strong one, and we've almost ended up the year flat. If we look at America, it's been a story of two cities. If you look at Atlanta, a very strong level of revenue growth. I don't normally separate the two, but here it was really important to show that. Double-digit growth consistently delivered. In California, which has been the starting place where we began escrow in America, we've seen a 10% drift in revenues. We found it incredibly difficult to recruit a general manager. Now, it's easy to make excuses for it. The simple fact of the matter is we didn't get it right and we didn't get somebody to stick. Where we are today is we've got an MD running the American operation. We've got a new general manager running the San Francisco business. It's early days, but the chances of him staying around are looking a lot more positive. If I told you the first one lasted a week, as he's been here now a month, that's a pretty good tenure. In Atlanta, everything's still staying the same. It's performing well. It's proving to us what we knew. The escrow market in America is a mighty big one. We're up against lots and lots of smaller businesses, plus the might of Iron Mountain, and we're making some significant inroads into their customer base, and will continue so to do. And that leads us really to everything I was saying there. You know, overall, if we look at the level of growth, we saw 2% revenue growth, 3% contribution growth. It has slowed. We're looking for that to return to a more normal level of growth, particularly in the UK, particularly as we see the market itself open up. It's about time that it should do so. And again, this is matching on to what I'd said before. The changes in North America, the changes in Netherlands have adversely affected us. We're through that now. That won't be a suitable excuse for a poorer performance. The level of growth that we'd expect to see out of those businesses is a lot closer to 10%. We're expecting those to be more like the performances we've seen in the past. We do believe we've got the right management team and structure in place to make a much better performance for the first half of this year and for the full year to come. And overall, the renewals base continues to grow. And remember, the key thing about escrow is renewals. Renewals and terminations. The renewals base is still growing. Termination rates across the piece has remained under 12%, and I expect that to remain the same. If you've read the report and accounts, you'll also see there's a fascinating insight into the SaaS world. And I'm happy to talk to you about the SaaS solution that we've got in place individually later on. If you're that interested, it really is fascinating. Let's turn to assurance. What we've mapped out here is just to give you a little bit of a scale thing. We've now created a pretty good bit of coverage across America. You know, we've started to grow in some of the security hotspots. We're going where the talent is. Of course, most of the talent, Alex will assure you, is in San Francisco, but there's an awful lot in New York. Chicago is a real hotspot. We're growing actively in Chicago. Austin, strangely enough, again, is another area that's worth focusing on. And there are a couple of decent-sized organisations in Seattle that it's worth making a base for. And again, we're also reflecting where the clients are. The client base in America for us are the great and the good. It really is, you know, the creme de la creme. Now, that's not to dismiss the UK. The size of the UK business now is fairly substantial. Again, we're providing services to all of the organisations in the Premier League. If you did read the piece on in the FT on the 1st of July that talked about the cost of cyber crime and everything else, it suggested that 21% of the FT 350 has actually started to put cyber security on the boardroom agenda. I think that's materially overstated. The cost of cyber crime to the UK alone last year was £27 billion. If that's got onto the top of the PLC agenda, I don't think it's done very well. And so this leads to what have we seen out of it? Revenue overall growth, 18%. Organic growth, 10%. Margin, still sitting at 17%. That's a good margin. The target is still 20%. Some of the issues I'm going to come on to with ISEC and Intrepidus have pulled that down a little bit in terms of our ability to move that on as quickly as we would like. We will be doing that. The integration of the new businesses is complete. They are part of NCC Group. It would be wrong to say that they're problem-free. Matisano, as we've talked about, is. One of the things we do as a group is we are formidable researchers. We don't always go out on a limb, but we do look at areas where we believe that if there's a public right to know, we'll go for a disclosure and we'll push hard on that. With Intrepidus, we had an interesting scenario. Firstly, we had issues with management, which we corrected relatively quickly, but also a piece of research that we did suggested that some of the 4G networks that were operated in the United States could be compromised, and very easily compromised. Our philosophy on research is that we encourage organisations to go through a careful process of remedying that problem. If they don't, then we're left with a difficult conundrum of do we disclose it? What would you do if that was your major client in the new business that you've just acquired? And that's the problem we have. One of our big revenue streams is one of those big operators where we as an organisation believe that some of the processes need to be speeded up in fixing a fairly fundamental eavesdropping problem with their communication network. And that has held back Intrepidus. It was bound to happen. There's always going to be a day where one of your clients is somebody that you believe are not necessarily performing in the way that you feel they should from a security viewpoint. It's also important that that sort of research continues, because that's where retention comes in. If we're seen as an organisation that just because we get a little bit of pressure turning around and saying we won't work with you if you disclose, would make us to our very successful and very important employee pool look incredibly weak. People have to feel that they're able to do the right thing. It's been a very big decision that we've had to take as a group, and it has affected Intrepidus pretty badly. And if you go into Black Hat, you'll see the talk. Things like retention have remained pretty good. I haven't talked about retention because when you start adding people from the United States into what's an accredited tester, frankly, it becomes a little bit of a false number. So I don't want to mislead anyone. I've always taught that retention is going to be going to be more than 90%. Yes, that is still the case, but in America you don't have the same definition of an accredited tester. In the UK, I refer to somebody as CREST or the equivalent. There isn't a similar body to refer to, so it doesn't make as much sense. But staff retention remains the same. And of course, the great thing about Assurance is the way that it develops new ideas. We're continuing to invest in new products, new ideas. Things like our denial of service attack tool, things like that are starting to get traction. Main part of it, it's a catchy little phrase, I know, STAC, Security Testing, Audit and Compliance. It's a mouthful if ever there was one. It is the largest part of the group. And within it is the US team. ISEC, you all know, a pedigree player, one of the businesses we most aspired to owning. We were delighted for them to come on board. They performed admirably. They earned their earn out quickly and efficiently, and it paid out in full. One of the things that you go through when you start to integrate a business is the situation with the founding members. One of our founding members decided he wanted to leave. The problem with that is he was the one who was primarily responsible for sales. Simple as that. We were too slow in putting a sales team out on the floor and getting it effective. We lost about 3 months of business performance out of ISEC due to that alone. That was fine because it meant the guys actually got more research time. But in terms of profit performance, yes, it dented it. Yes, we were very effective at getting that back on track. We were very effective at finding other work for some of them to be involved in. We were very effective at joining up the new New York businesses that we'd got. But that created a hole. Disappointing. It was dropping a ball that we shouldn't have dropped. Where are we today? Well, we've got a stable management team. We've increased the size of it by moving people from the UK over to America. I can't understand why any of our senior employees would want to live in California, but a couple of them seem to want to do that. So we've taken a senior operations person and a senior finance person, and they're crossing over to California as we speak. And we now have a fully fledged sales team. The Intrepidus business I've talked about, the recovery plan is in place. If we do lose ultimately that large mobile telecoms player, so be it. There are plenty of other opportunities in New York where it's predominantly based. And we're working hard at moving it firstly all into the same office, but actually finding those clients with that sales team. The future, very, very bright. The US takes cybersecurity really very seriously, much more seriously than we do in Europe. And we are one of the few global players that can actually harness that. Web performance, it's the one everyone forgets, and it's one of my favourite businesses because it does everything that I like. The classic accountant's business, high renewal rates, high margins, high growth. It's great. It's a good little business. What it also does, and I've said this many times, is it provides some of the automation know-how to the rest of the group. Artemis will be using features of this. The DDoS tool was partly developed using some of the technologies and know-how we had in this business. They're people who are really good at writing automated monitoring type tools. They know what they're doing. And guess what? That's stuff that we do. And guess what? That's part of what needs to fit into the Artemis world. So it's a really important bit. Interestingly, we rolled a little bit out of it into Australia, where it seems to be being relatively well picked up on. And we're now considering putting it into North America. Why? Because it's complementary to everything we do. And it fits very well.
Lots happened in the last year since updated you guys last year. Around July of last year, things were still really fuzzy from the ICANN process. They hadn't decided yet what the calendar was going to look like. They hadn't figured out how they were going to order applications. Since then, a lot of things changed, especially in December of last year. ICANN did a draw, so they decided in what order the applications go. We pulled 831, so we're right kind of in the middle of the 1,900 applications for TLDs. And they've started to get serious about making decisions. So as I'm sure you all know, we put our application in April 2012, 320-page application, $185,000 application fee. That application was cut up into 5 pieces and sent around to a bunch of different consulting companies to judge it against a rubric. Those scores were all added back up, and we passed with flying colors. So ICANN calls that initial evaluation. It's actually final evaluation if you pass it. So there's no other ICANN judgment for us to go through to win .secure. We're now officially in the contention phase with Amazon, who is the only other applicant for .secure, and their number is 935. So they passed initial evaluation right the week after us. And so we've been officially in contention with them with something like 6 days. And we're hoping that now that we are both passed, that we're able to have a good resolution, a friendly resolution to our conflict. I'm pretty confident we're going to get .secure. There's a number of different political decisions ICANN has made that have moved pretty strongly against the kind of application Amazon put in, which is called a closed generic. And in all honesty, I think Amazon would benefit more from being part of our gated community run by us neutrally, where all of their competitors and other major tech companies can participate, than it would be for them to operate .secure all by themselves. So we're looking forward to productive discussions with them, hopefully starting at the South Africa ICANN meeting, which starts in about 2 weeks from now. A lot of progress on us from a Pioneer standpoint. I'll get into that in detail. We're still shooting for a target live date of next year. I think Atul covered the numbers. We can go back to those a little bit later if you want. We have 30 signed Pioneer customers and 10 strong potentials. This is well over our target. Our initial target was to have 25 Pioneers, but we had a oversubscribed demand, a number of very interesting and large companies who wanted to get in, and clearly we're not going to say no as long as we can keep the quality of the applicants up, as well as the group small enough for us to have productive conversations. Of those 30 signed Pioneers, we have some major financial institutions, 3 of what we refer to as the too big to fail banks in the United States, as well as a bank of equivalent size here in the UK. We have a number of tech leaders, companies that do things like write browsers and ship phones. Social networks, of the 4 major social networks, 3 of them are Pioneers, and we're working on the 4th. The consumer products, a couple of major consumer products companies, several major global entertainment companies under which many brands exist. We have one of the largest healthcare companies in the United States, 2 of them actually. And we have 10 more potentials waiting in the wings. That should probably be it for us for the Pioneer program after we sign those folks up. Because as you can see on this calendar, we'll move in the end of this year to pre-sales, and the Pioneer program becomes less relevant. So looking at the calendar, in May, the Pioneers met. We had 28 of those companies meet with us physically in New York for a day of meetings where we talked about the technical standards we're building, integration with browsers, what kind of policies we're going to enforce in our gated neighborhood, as well as what the timeline would be like for them to get on board with us. We passed our evaluation in June. This week, we started testing on our platform. So since last year we spoke, we've come very far in building our continuous compliance platform that powers .secure. And this week we're starting testing on a major e-commerce site is one of the tests, which gives us the ability to test a shallow but very broad infrastructure. and a major independent software vendor, which gives us a smaller number of pages but a much deeper technology. So we're picking out pioneers that give us a good representative technologies to test, and then we're planning on between Q3 and Q4 opening that first to all of our pioneers, and then anybody who does pre-sales. Clearly, contention resolution is a big focus this summer and fall, with the goal of us in Q4 of this calendar being able to offer .secure names for pre-sale. Starting next year, early, we will finalize the .secure policies via a number of physical and online meetings with our pioneers. We'll publish those next year. Hopefully, at the current rate, we're expecting around the end of Q1, beginning of Q2 calendar for ICANN to turn us on to do what's called DNS delegation. That means we have the ability to actually run .secure names. This is based on ICANN's estimate of the first delegation happening in September, and then ICANN turning on 100 names per month after that. That's ICANN's schedule that they've published, and we are 800 into that. Now, we won't actually be the 831st to be turned on. There's a number of folks before us that will have to step out of line because they'll be in contention still, or they won't be ready. But still, it's difficult for us to estimate because ICANN's still a little bit fuzzy. Once they launch, if they hit their deadline in September, then we'll be able to get a much firmer understanding of what their rate looks like and when we can actually turn on. Now, when ICANN turns us on is not the date we'll really launch .secure. As you can imagine, we are not just a normal top-level domain. We can't, we're going to have to be as reliable and as robust as .com, the .com sites, domains that people are leaving. And so we are building a very robust and large physical infrastructure around the world to be able to handle the load and handle malicious attacks against us. So we're going to be spending the time between us being turned on and launch to turn our very successful DDoS tool against, which has been successful in knocking out some major banks and major DDoS providers. We'll be turning that against ourselves and doing that while we simulate a number of failures. So we'll be sitting there watching screens in a big room and destroying ourselves as much as possible, and then doing things like pull the plug on the African server, pull the plug on the one in Singapore, pull the plug on Tokyo, and building a robust network that in any foreseeable future that we're able to still provide the services that we're promising our customers. And then our goal is in Q3 of next calendar year to launch .secure and then to turn on general availability. We will have pre-sales for folks who meet what are called the ICANN Sunrise requirements, which basically means you have an existing GTLD or a trademark that coordinates with that name, and then the general terms will be available after we launch, hopefully in Q3 of next year.
Yes, it's very much live, Artemis, as a proposition. It's moved from being a theoretical application into an accepted application through a solution that we've started to demonstrate to some of our pioneers, that we've started to pilot, and very quickly it is going to be live, which really moves beautifully to the current trading and outlook page. As I've already said, the cornerstone of the business, the escrow business, we expect to see more normalised performances return from that, particularly from the overseas. Assurance, the marketplace we're in, you only have to read the FT 1st of July, bottom of the front page. Top companies lack vigilance in preventing the threat of cyber crime. Well, that couldn't be a better marketplace for us to take the opportunity from. The scale and international reach of our group is absolutely unique. If we look at the order book that we've got, 51 million is a fairly substantial uplift on last year. I think it was about 44.9 if my memory serves me right. That would be roughly a 15% uplift if my fag packet calculation has just worked. As importantly, we've got Artemis looking like it's coming through. The costs are in control. The CapEx numbers are as we've suggested so far and look to be about right. And we expect to start to see some form of revenue come through in this financial year, which has to put us in a position where we're very confident about the year we're entering into, and we're looking forward to a year of strong and consistent growth.